Good afternoon. Good afternoon. Good afternoon. Yesterday, in our last session, we discussed about various tax scheme, tax rates for companies and the various provisions of the income tax law. There are some transitional schemes are there like 115 BA, B, A, B, and D, double A, and we discussed the what is the types of company, Indian company, domestic company, when a foreign company is termed as a domestic company. We discussed all this part. Now, in last session, we initially started with minimum alternate tax. Why minimum alternate tax? We discussed in our last session. Now we are discussing the entire minimum alternate tax, the provision relating to minimum alternate tax, that is MAT, which is covered under section 115 JB of the income tax law. Let's start with the entire provision of the minimum alternate tax. My screen is visible, my presentation is visible. Now, minimum alternate tax, we discussed the provision is applicable to all types of company, whether it is an Indian company or a foreign company. In case of few foreign companies, exceptions or the provision is not applicable. We will discuss later on. In general, each and every company is covered under the provision of the minimum alternate tax. Specifically, the provision is applicable in case of company. That means in case of individual, in case of partnership firm, in case of LLP, the provision relating to minimum alternate tax is not applicable. However, there is another mechanism called alternate minimum tax, AMT. The provision relating to AMT is applicable in case of individual HUF and LLP partnership for other persons. In case of company SSE, if a person is the company, then the provision of section 115 JB is applicable, whether it is an Indian company or foreign company, barring few foreign companies. Exception. However, if the company is a life insurance business company, suppose a company is deriving income from life insurance business, then the provision relating to 115 JB is not applicable to that type of business, as well as if the company opt for provision relating to 115 BAA or provision relating to 115 BAB, which we discussed in our last session. In these situations also, the provision relating to 115 JB is not applicable. That means there are 3 exceptions. In fact, there are 4 exceptions. Few foreign companies are exempted from minimum alternate tax under section 115 JB. If life insurance business, which is covered under section 115B, and if a company opt for under that is 115 BAA as well as 115 BAB. If company are in these situations, then provision relating to 115 JB is not applicable. Barring this, in each and every type of SSE, the provision is applicable. 1 second. Got it? Now, what is the scheme? First of all, a company is required to prepare the profit and loss account as per Schedule 3 of the Companies Act. First of all, you are required to prepare a profit and loss statement as per Schedule 3 of the Companies Act. On each and every company, Schedule 3 is applicable, barring few specific company like insurance business, like electricity, and like the banking company, where a special regulation is available. If the company is engaged in a banking business or electricity business or insurance business, then the PL should be prepared as per respective act which is applicable to that company. Okay, if the company is not engaged with this type of business, then Schedule 3 is applicable. The PL should be prepared as per Schedule 3 of the Companies Act 2013. You are supposed to adjust the profit as per explanation 1 of the 115 JB. In explanation 1 of the section 115 JB, few adjustment has been given. Few items are required to be added back in the profit and loss, and few items are supposed to be reduced from your profit. The resulting figure is termed as both profit. What are these items? We will discuss later on. You just understand that there are a list of items which you are required to adjust in your profit figure. Whatever you have in your whatever profit you have in your PL account, you are supposed to adjust that profit as per the explanation 1 of the section 115 JB to derive both profit. There are some plus items, there are some minus items. What are the items? We will discuss later on. The resulting figure is termed as both profit. The resulting figure is termed as a both profit. What is the meaning of both profit? Net profit as per PL account as adjusted by certain items which are given in explanation 1 of the section 115 JB. This is called both profit. You are required to compute 15% of both profit. 15% of both profit. Compare that figure with your normal tax liability. What is normal, sir? This is not abnormal. That means other provision. You are required to compare 15% of both profit with your regular tax liability. Whatever be the tax rate applicable on you, you computed your income, applied 30% or 25%, whatever be the rate, you applied that thing. Just compare two figures, the 15% of both profit and your regular tax liability. Whichever is higher shall be considered as your tax liability. Apply surcharge and cess thereon. That's all. That is the scheme. However, if the unit is located, if your unit is located in International Financial Service Center, then instead of 15%, apply only 9%. Relating to the income, which is the income is relating to a unit located in IFSC, then instead of 15%, apply 9%. Got it? Any question? Any query? This is the basic scheme. What is the scheme? The provision is applicable in case of all company, Indian or foreign, barring few foreign companies. However, the scheme is not applicable in case of a company engaged in life insurance business or a person who opted for 115 BAA or 115 BAB. What is the scheme? Prepare PL account as per relevant act. Adjust that profit. The profit in the PL account should be adjusted as per explanation 1 to the section 115 JB. The resulting figure is your both profit. Compute 15% of both profit. Compare that 15% of both profit with your regular tax liability. Whichever is higher shall be considered as your tax liability. Apply surcharge and cess accordingly. That's all. Got it? Now next. Suppose you are preparing books of book profit as per Schedule 3 of the Companies Act 2013, but can you prepare two different sets of books of accounts? Suppose I'm preparing a books of accounts for the purpose of AGM. In that set of book of profit, I'm following WDV method of depreciation. That is as per Schedule 3. Okay. Now, for the purpose of income tax law, I also prepared a different set of books of account in which what I did, I changed the method of depreciation. I shifted from WDV to straight line method. So there are two different sets of books of accounts. For one for the AGM purpose, that is for shareholder purpose, and one for income tax purpose. Sir, is it possible? Yes. What was mentioned? The PL should be prepared as per Schedule 3 of the Companies Act. I am following WDV. I am following straight line method. Both are as per Schedule 3. There is no bar that I am supposed to follow WDV method. That is not required. This is option of the management whether to follow WDV method or SLM method. Everything is under the umbrella of Schedule 3, but I prepare two different set of accounts. Number one. Number two, for example, there are few expenditure which is supposed to amortized. For the purpose of shareholders, I amortize that expenditure in 10 years. For the purpose of income tax, I prepared a different set of accounts in which I amortize that expenditure for 5 years. And I am giving notes to that this particular expenditure we are amortizing in 5 years. And for the purpose of shareholder, we are giving a note that this expenditure is amortized in 10 years. Whether I am wrong or not, I am not wrong. I am following this Schedule 3, but these change in accounting policy, change in method of depreciation, change the options given in under various accounting standards results. What is the results of this deviation? What is the result of this variation? There may be change in the figure of the profit. There may be change in the figure of the profit. Suppose in the share the accounts that prepared for shareholders, there might be a profit of rupees say 10 crore, considering depreciation as per WDV method. Is it possible if I am following SLM? If I am following SLM, then my profit might be 8 crore or 12 crore. Are you agree with that thing? The impact of method of depreciation, method of accounting policy is on profit. I prepare two different set to deviate to avoid minimum alternate tax. Government says no, but no. You are supposed to prepare the books of account as per following the same accounting policies, same accounting standard, same methods and rate of depreciation which you are following for the purpose of AGM. That means the accounts should be same. Is it not like that? There are two different sets of accounts. No, you are supposed to follow same accounting policies, same accounting standards, same methods and rates of depreciation, which you are supposed to follow while preparing your books of accounts for the purpose of AGM. Got it? Now, few persons are like this. For the purpose of income tax law, April to March is mandatory. Is it possible to follow different year as for the purpose of companies? Nowadays, I think it's not possible. So I'll leave it. But profit as per Schedule 3 of the Companies Act 2013, accounting policy, accounting standards, methods and rate of depreciation shall be the same as have been adopted for the purpose of preparing such accounts and laid before the company at its annual general meeting. You are supposed to follow same accounting policies, same accounting standards, same methods and rate of depreciation. However, suppose you follow WDV method and your resulting profit is 10 crore. However, if you follow SLM, then your profit might be 12 crore. AO cannot raise any question. AO cannot raise any question why you are not follow SLM method. You avoided tax by following WDV method instead of SLM method. AO cannot raise any question. Since WDV method is also supported by Schedule 3 of the Companies Act, SLM is also supported. If I follow WDV method and my books of accounts are prepared as per Schedule 3 with the same accounting policy, same accounting standards and same rates and methods of depreciation, you cannot raise any question why not I opt for another way of preparing books of accounts. This is not his area. He cannot disturb, he cannot raise any question regarding my accounts if it is prepared as per Schedule 3 of the Companies Act. If it is not prepared as per Schedule 3 of the Companies Act, then he is fine. He may raise question, he may disturb my PL account. However, If it is followed, then he cannot say like this, you followed WD method, you are supposed to follow SLM. He is not the right person. He is not the correct authority to raise this type of query. If it is as per Schedule 3 of the Companies Act, and if it is obviously in case of company, it is certified by this auditor. Got it? If you have any question, you may ask. Now, we discussed earlier, in case of few foreign companies, the provision relating to 115 JB, that is MAC, is not applicable. What are these? If assessee is a resident of a country with which India have an agreement under section 90 or 90A, that is bilateral agreement to avoid double taxation, that is called DTAA. Condition is this: assessee does not have any permanent establishment in India. If these conditions are fulfilled and there is an agreement between the country, corresponding country, then MAC provision is not applicable in case of that foreign company. Number two, if assessee is not a resident of those territories, suppose the foreign company is not a resident of a country with which India have any agreement under section 90 or 90A. In that case, condition is like this: if assessee is not required to seek any registration number as per company law. If it is required, then 115 JB is applicable. Otherwise, 115 JB is not applicable. And last one, suppose the company is engaged in the business which is covered under section 40B, 44BB, 44BB, or 44BBB. Like suppose the company is engaged in the business of aircraft. Suppose they are carrying passenger from Mumbai to London, London to Mumbai, and again Mumbai to London. This is their business. Airlines, if that company offered the income as per respective provision covered under section 44B or BB or BBA or BBB, whatever the section applicable to this type of business, and tax is paid accordingly, then the provision relating to MAC is not applicable. In case of aircraft business, 5% shall be considered as their income. In case of shipping business, 7.5% is considered as business. Like there are presumptive income. The provision relating to presumptive income is applicable, which is covered under section 44B, BB, BBA, or 44BBB. If the company offer the income as per the presumptive sections and tax is paid accordingly, then question of MAC does not arise. Got it? One formalities are required, one compliance is there, that is the company is required to submit a form called for 29B, that is not along with return, that is 30 days prior to the due date of furnishing the return. That means, suppose in case of a company, the due date of filing return of income is say 31st October, then this form 29B shall be uploaded by 30th September. And that form number 29B is required to be certified by a chartered accountant, stating that both profit has been computed as per law. Okay. Any question? Now, there is an illustration to understand the provision relating to MAT. This is a very simple illustration. We will discuss few more complex problems. Business income before adjusting brought forward losses and book profit of X Limited for various years are as follow. In case of year 1, there is a loss of ₹2 lakh as per regular provision of the income tax, and book profit after adjusting their PL with few items which is given in explanation 1 to section 115 JB. is rupees 1 lakh. Now how he will approach? Business income after set off is rupees 2 lakh. That is a loss 2 lakh for the year 1. Tax on above, since there is a loss, there is a no tax as per regular provision. Book profit is this one, 1 lakh. 15% of book profit comes to rupees 15,000. We are supposed to compare this 15,000 with this nil. What will be the higher? I think 15,000 is the higher, 15,000 or nil, whichever is higher, 15,000 is higher. That shall be considered as his tax liability. That shall be considered as tax liability of this company. Surcharge, whether surcharge is applicable or not. Be careful. If you are paying tax under MAT, in that situation, book profit shall be considered as your total income, and accordingly think whether surcharge is applicable or not. In this case, your total income for the purpose of surcharge is rupees 1 lakh. That is, since you are paying tax under the MAT, henceforth, book profit shall be considered as your total income. Since total income is only my 1 lakh, henceforth, surcharge is not applicable. Surcharge is nil. Tax and surcharge comes to 15,000. Health and education cess is 4% of tax plus surcharge, comes to rupees 1,600. Altogether, my tax liability is rupees 15,600. What government got? Is it benefit to the government? Suppose there was no provision like section 115 JB. In year 1, government will get nil amount of tax from the X Limited. Since there is a provision like 115 JB, still government is getting rupees 15,600 from the company X Limited. It is beneficial to the government. Government is getting something that is minimum 15,600 they are required to pay. Okay. In year 2, as per regular provision, there is a business income of rupees 1,50,000 before adjusting brought forward losses, and both profit is rupees 60,000. Now, in year 2, business income after set off, since there was a loss of rupees 2 lakh, which is supposed to be carried forward. Now 1,50,000 is the income. The 1,50,000 brought forward loss shall be adjusted with this income. Henceforth, my income is nil. Accordingly, since income is nil, my tax on that income is nil. Now, both profit is rupees 60,000, which is given. On this 60,000, I am supposed to apply 15%. That comes to rupees 9,000. 9,000 or nil, whichever is higher. 9,000 is higher. That is my tax liability. Since I am paying tax as per section 115 JB, my total income is rupees 60,000. Whether surcharge is applicable or not? No, surcharge is not applicable. That's why surcharge is nil. Tax plus surcharge comes to rupees 9,000. I applied 4% education cess amounting to rupees 360. Altogether, I am liable to pay 9,360. Though, as per regular provision of the income tax law, I am supposed to pay nil amount. Still, government is getting something from X Limited, that is 9,360. That is the magic of 115 JB. Got it? In year 3, the company earned 1,25,000. The business income of the company is 1,25,000 as per the regular provision of the income tax law, and as per both profit, it is 2 lakh. Now, since 1,25,000 before set off, the remaining figure of rupees 50,000, that is 2 lakh. 150 was adjusted in year 2. Out of this loss of rupees 2 lakh, 1,50,000 was adjusted in year 2. Remaining 50,000 is supposed to be adjusted in year 3, resulting 75,000 is my income for year 3. On this 75,000, I applied 30%. That comes to 22,500. And my book profit is rupees 2 lakh. 2 lakh. On this 2 lakh, I applied 15%. That is 30,000. I will compare this 30,000 with 22,500. Whichever is higher shall be considered as my tax. 30 or 22,500, whichever is higher, 30,000 is the higher one. What is my total income for the purpose of surcharge? It's only 2 lakh. Since such income is only 2 lakh, henceforth my surcharge is nil. Tax after surcharge comes to rupees 30,000 and applied 4% amounting to rupees 1,200. Altogether, I am liable to pay 31,200 as per to the government of India. Any question? Suppose I am extending the illustration for year 4. Suppose business income after set off, since there is no loss remaining to adjust, there is an income of say 1 lakh. On this 1 lakh, I am supposed to pay 13,000. Book profit say 90,000. I am supposed to calculate 15% of book profit. What is the 15% of book profit? 9,000 plus 4,500 comes to 13,500. I will compare this figure. I will compare this figure 30,000 with 13,500, whichever is higher. 30,000 is higher. Surcharge. Now I will consider my total income as rupees 1 lakh. My total income is considered as 1 lakh because I am paying tax as per regular provision. 1 lakh, on 1 lakh there is no surcharge, nil. Now tax plus surcharge comes to rupees 30,000. Education says it comes to rupees 1,200. Altogether 31,200. Okay, got it? Be careful here. One thing is missing, that is called MAT credit. We will discuss later on what will be the effect if our regular tax is higher than our minimum alternate tax. If our regular tax, in this case, our regular tax is 30,000, whereas my tax as per MAT provision is only 13,500. That means I am paying tax under the regular provision of the Income Tax Act. That's if this is the situation, then there is a concept called MAT credit is available. We will discuss that MAT credit afterwards. Okay. Any question? Any query? Anyone have any query? May raise your queries. Oh, there is no query. The next, no impact of MAT on losses. What you seen here in this case, in this illustration, did you notice that my loss has been adjusted? I paid tax in year 3. I am supposed to adjust only remaining loss. That you cannot say that since I already paid tax, so how could I adjust my loss? There is no benefit of adjusting loss. In year 2, I did not get any benefit of adjusting loss. In year 3, I did not got any benefit of adjusting loss. Still, I am paying tax. In year 2 is the clear case. In year 2, I adjusted my loss with the current year income. I adjusted my brought forward loss with current year income. Though still I am paying tax under MAT provision. So whether I got any benefit for this adjustment or not, the law states that whatever with the you are paying, the whatever amount you are paying under MAT or under regular provision, the set off and carry forward will work accordingly. That is not like that. Since you are paying tax, the set off provision will stop. It is not like that. You cannot say that since in year 1, in year 2, since I am liable to pay 9,000, I will adjust only that much amount of the losses to adjust that 9,000. It is not like this. That the set off and carry forward is a separate procedure that will be continue. You cannot stop that provision. You cannot say that since I am paying tax, so why I am adjusting that losses with my current year income, I will further carry forward that loss. That is not so. That is not possible. You are supposed to adjust your brought forward loss with your current year incomes. You don't have any option. You don't have any choice for doing that thing. Okay. Furthermore, other provisions will apply. What are other provisions? Like advance tax, like interest are applicable. Whether you are paying tax as per regular provision of the Act or as per minimum alternate tax, that is 115 JB, if whatever be your tax amount, you are supposed to estimate that thing and you are liable to pay advance tax accordingly. You cannot take like this one. Suppose as per regular provision, my tax is nil. As per my MAT provision, my tax is say 1 lakh. I did not pay any advance tax. I did not pay any advance tax. Be careful. I'm liable to pay advance tax, though I am paying tax under MAT. You cannot say that since books of accounts are yet to be finalized, how could I estimate? In that case, government is saying that how could you estimate your income tax computation if you are paying tax as per regular provision? Still, you are estimating in case of regular, if you are paying the advance tax as per regular provision, still you are estimating your advance tax liability. So what is the difference? You are supposed to estimate your advance tax liability whether you are paying, irrespective of the fact that you are paying tax under minimum alternate tax or under regular provision of the income tax law. You are supposed to estimate your advance tax liability and you are supposed to pay your estimated advance tax liability as per given schedule of the advance tax. What are the schedule? What are the due date for payment of advance tax? That is 15th June, 15th September, 15th December, and 15th March. By 15th June, you are supposed to pay 15% of your estimated advance tax liability. By 15th of September, you are supposed to pay 45% of your advance tax liability, and by 15th of December 75%, and by 15th of the March 100% of your estimated advance tax liability. If you fail to pay this type of advance tax, interest provision, whether it is 234B or 234C, the provision will be applicable. Got it? That means in any other situation, government is the winner. In each of the situation, government is the winner. Any question? Any query? Now next. Computation of birth profit. We discussed that while computing tax under the MAT provision, you should start from net profit as per your PL account. That PL should be prepared as per Schedule 3 of the Companies Act. And you are supposed to adjust few items which is given in explanation 1 to section 115 JB. These are the items. This is the list of the items you are supposed to adjust. You are supposed to adjust. Before starting this adjustment, before understanding this adjustment, first thing you keep in your mind, since this is a dimming provision of the income tax law, we are forcefully dimming your income. So whatever the mention as per adjustment, you are supposed to follow that thing word by word. Don't apply your mind, don't apply your logic whether to do that thing. Logically it is correct, logically it is incorrect. You are not supposed to apply your logic. If the provision is dimming provision, you are supposed to follow law word by word. This is a thumb rule. That is the one of the rules for interpretations. Whatever in every dimming provision, you may apply this theory, this thumb rule. In case of dimming provision, please write down this. Then this is the rule of interpretation. In case of dimming provision, you are supposed to follow the law, the script of the law, word by word. Don't apply your logic. Don't apply your mind. If it is say this should be added, you just add this thing. If it say this should be reduced, you reduce that thing. Don't apply your logic. Don't apply your mind. Since this is a dimming provision, you are supposed to follow you are supposed to calculate both profit by adjusting each and every item. Whatever the item is mentioned, you are supposed to adjust. Got it? Now start. Both profit means the profit as shown in the statement of profit and loss account for the relevant previous year. You just start from profit and loss, profit or loss figure, which is shown in your PL statement. Now, few items are required to be added and few items are required to be reduced. If it is added, if it is debited into the PL statement, reduced if it is credited in, debited in the, credited in your PL statement, barring few items. First one, income tax paid or payable and the provision therefore. If you made any provision for income tax, whether it will be reflected in your PL account or not, it will be reflected in your PL account stating provision for income tax. You just prepare your PL like this: sales, expenses, profit before tax, now provision for tax, resulting figure is your profit or loss. You are starting from this. You are required to add back whatever the provision for income tax you have made. You are supposed to add back. That it will increase your profit. It will increase your profit. Income tax paid or payable and the provision thereof. Number 2, transfer to any reserve by whatever name called. If you transfer any money to any reserve by debiting PL account, you are required to add back. For example, what I am doing, sales 10 crore, expenses including purchase say 8 crore, transfer to general reserve 1 crore. Is it possible? Now my net profit is 1 crore. If this is the case, whatever amount you transfer to any reserve by debit to be added back. It should be added back. Is it clear? Now, third one. Provisions made for meeting liabilities other than ascertained liabilities. If you made any provision, for any liability and that liability is uncertain, that provision is required to be added back. What is the case? For example, sales 2 crore or 20 crore, expenses 15 crore, provision for contingency say 3 crore. I presume that the future is uncertain, so I made a provision for contingencies 3 crore. Do you think this contingency, this liability is certain or this is uncertain? Since it is made for contingency, that is made for uncertainty. Say henceforth, this type of provision is for uncertain liability. It is required to be added back. Else, there will be no profit in each and every PL account. There will be no MAT provision is applicable because each and every person will apply this logic to avoid MAT. So government is very clever. They states that if the liability is uncertain and you provided for that liability, that should be added back. What happened if I provision for audit fees? The liability is certain, not required to be added back, unless and until if it is hit by any other line items. What about provision for gratuity? If it is ad hoc provision, it should be added back. If it is calculated, there is a backup of that the provision, how you create that provision. Gratuity is a certain liability, but quantification is not certain. Provision for gratuity, try to understand that. Provision for contingency, the liability itself is uncertain. Provision for gratuity, the liability for gratuity is certain, but quantification is uncertain. What will be my liability for gratuity will confirm after few years, say after 10 or 15 days. This is a new venture. After 15 or 20 years, when one person is retired, then I can compute, then I may say that my liability is freezed. But there is a liability. The liability of provision for the liability for gratuity is certain. But what is missing? What is not certain? The quantification. If it is ad hoc, you just add back. And if it is on the basis of certain scientific calculation, scientific annuity calculation, or like that, if there is a backup, if there is a scientific method for calculating that provision for gratuity, and you provided that much amount in your PL account, it is not required to be add back, because here liability is certain. Got it? One more thing, provision for tax. Provision for tax. Here the liability is certain. There is a tax, and I calculated that thing as per the my computation sheet. Have some backup paper, have some scientific calculation behind creating provision for tax, whether I'm required to add back or not. Provision for tax is not required to be added back considering this provision. However, it is required to be added back due to this provision. First one. If it is covered by any other line item, then you are supposed to go with that thing. This is a general provision, and this is a special provision. Got it? Next one, provision for losses of subsidiary company. If you provided for losses of subsidiary company, it should be required to be added back. Dividend paid or proposed dividend or whatever. If it is paid, then it is dividend paid. Since this is mere application of your income. It is not diversion. It is not incurred for the purpose of earning that income. It is after earning income, you are paying dividend. And your tax liability is on your income, not on the amount which remains after paying dividend. The income tax liability is on income, not on after paying dividend. Dividend is the mere application of your income which you earned during the previous year. That's why they are saying whatever the proposed dividend or dividend paid is, if it is debited into PL account, it should be added back. Got it? Now next, expenditure relatable to any income to which section 10 or section 11 or section 12 apply. And simply put this into this simple example, sale, say 5 crore. There is agricultural income, say 2 crore. Expenses 3 crore. Expenses for this agro income, say 1 crore. And my net profit 3 crore. If this is the case, if you start with this 3 crore, if any income, any expenditure is related to any income which is covered under section 10, 11 or 12, that is exempt. In that situation, the expenditure relating to the income which is exempted under section 10, 11 or 12, that expenditure is required to be added back. Whether it is provision or actual expenditure, it is required to be added back. Right? Don't worry. The income portion shall also be reduced while computing your book profit. We will discuss afterward. And hence, how you will calculate net profit 3 crore add expenses on agro income 1 crore less agro income 2 crore. Sorry for my poor handwriting because uh, my laptop is standing. It is not possible to write now. 3 plus 1 minus 2 comes to 4. 4 minus 2, it's 2 crore. 2 crore is my book profit for the purpose of 100 and section 115 JB. Similarly, if any expenditure relatable to the income being share of profit from AOP is debited into your PL account, it should be reduced. It should be added back, provided the share is exempt under section 86. In few cases, share from AOP is exempt. If AOP is taxable at the maximum marginal rate of tax or higher rate, in that situation, whatever the share you are getting is exempt in your hands under section 86. If this is the case, whatever the expenditure you incurred for earning that income, that shall be added back. And similarly, on the other side, the relevant income shall also be reduced by computing your work profit following the same analogy. Got it? Now next. Expenditure relatable to income by way of royalty in respect of patent chargeable to tax under section 115 BBF. There is a section called 115 BBF where patent royalty from patent is taxable specifically at the rate of 10%. If your income, if your PL account contains some expenditure which is related for earning this type of income, that expenditure is required to be added back. Correspondingly, we will also reduce income. Depreciation. You are required to add back whatever depreciation you have debited into your PL account. You are required to add back. Don't worry, depreciation shall be further reduced. Okay, deferred tax and provision thereof. What is deferred tax? That is prepared according to accounting standards. I don't remember what is the number of accounting standard, but deferred tax is prepared as per accounting standard. If it is debited into your PL account, it should be added back. That means it is nothing but tax item. It is required to be nullified. We are nullifying the effect of deferred tax. Provision for diminution in the value of any assets, like assets written off, etc. Earlier, we discussed that provision made for meeting liabilities other than certain liability. In this clause, can I say that what will be the fate of provision for bad debt? What is the fate of provision for bad debt? Whether it is required to be added back or not. I have debited PBDT in my PL account amounting to ₹1 crore. Whether it is required to be added back. If we go through this language, provision made for meeting liabilities other than a certain liabilities. Can I say provision for bad debt is made for meeting liabilities? Is it so? No. Provision for bad debt is created for diminution in the value of my asset. That is for the purpose of asset. It is not linked with my liability. Henceforth, that item is not covered with this line item. Till now, we are not supposed to add provision for bad and doubtful debts because it is not meeting this criteria. We are not supposed to apply our mind. Since this is a Deming provision, we are not supposed to apply our mind. This is provision made for meeting liabilities. Since PBDT is not made for meeting any liabilities, addition should not be made. Government analyze this fault. They introduce one more line item. What is that? Provision for diminution in the value of any asset. Now, if you are reducing the value of any asset, if you are providing any provision for any asset, that situation, it is required to be added back under this line item. This is the new. This was the inserted by the government of India later on, when certain disputes or certain case law was there. Got it? Any question? Now, amount standing in revaluation reserve relating to revalued asset on the retirement or disposal of such asset if not credited to the statement of PL account. What is it? Now think about one beautiful planning. Actual cost of the asset is rupees 10. Actual cost of the asset is rupees 10. I revalued that asset by 100 rupees. Now, what will be my journal entry? Asset account debit 100 to revaluation reserve account 100. I am correct or wrong? The entry is absolutely correct. I sold that asset after revaluation for rupees 150. So I got money in my bank account. So I debited bank account by 150. I credited asset account. Now it is 100 plus 10. Total comes to 110. To my profit on sale of assets account 5. This profit on sale of assets account, that is 5, was transferred to my PL account. And I transferred this revaluation reserve since it should not, now it is not required. I am required to witness since it is materialized, it is converted into actual profit. Henceforth, I transfer this profit to general reserve. Revaluation account debit 100 to general reserve. By this way, this debit, this credit is adjusted. Now my entry is in, my profit is in general reserve. I'm following all standards or not? I have followed all standards. I'm giving a note. The amount transferred to general reserve belongs to certain transfer of assets, sale of certain assets for rupees. This one that was revalued earlier. I give everything in my notes to that notes. But do you think what I did in my PL account? Say net profit before this item is rupees 1 crore. I only credited this PL 5. I only credited profit on sale of transfer, sale of asset. Now it's become 6. Instead of 105, I transferred only 5 to my PL account. 100 was transferred directly to general reserve. My PL reflects 6 as my profit. My computation as per 115 JB, my computation for book profit shall start from 6. That's all. There is no debit or credit in general reserve through PL account. Henceforth, nothing is required to be added back. Henceforth, nothing is required to be added back. If the money is transferred from PL to general reserve, it is required to be added back by provision of this one. This one. Transfer to any reserve by whatever name called if the following amount is debited in the statement of PL account. Here, can you say the amount of rupees 100 was transferred to general reserve? That's fine, but it is transferred by debiting PL account. No, it was transferred by debiting revaluation reserve account. So nothing is required to be added back. Due to here it is mentioned that if it is debited in the statement of PL account, then only if amount is transferred to reserve account by debiting PL account, it is required to be added back. In our example, the amount was credited to general reserve, amount was transferred to general reserve without debiting PL account. Henceforth, till now, there is no adjustment required. We are not supposed to apply our mind. This is a deeming provision. Government should thought about this type of lacuna. Government thought. What they said. Amount standing in the revaluation reserve relating to revalued assets on the retirement or disposal of such asset, if not credited to the statement of PL account. If that money is not credited to PL account, it should be added back. Hence, due to this line item, my both profit shall be increased by 100. That means now my both profit should be 106. 6 is my PL. Add 100. That is amount in the revaluation reserve account. Got it? Any question? Any query? There was a lot of tax planning people did to cover all this planning. Government added few line items into this adjustment list. Earlier that list was not so long. Earlier the list was very short, but people applying their mind to avoid tax under the both profit. So whatever the government comes to know about this type of planning, the intention was clear. They added few more adjustment. Got it? Any question till now? Oh, there is a time. 6 o'clock is already there. Oh, it's a very long list. One last item we will discuss. Our remaining item we will discuss some other day. Expenditure relating to following income of a foreign company, if tax payable on such income under normal provision is less than 15%. If you are a foreign company, few items are few income is taxable at the rate which is below 15%. Say in case of some capital gain, it might be taxable at a rate of 10%, 5% or whatever, but the rate of tax on that income is below 15%. If this is the case, whatever the expenditure relating to that type of income, you are required to add back, and correspondingly we will reduce the respective income while discussing the reduction items. Got it? The capital gain arising or transaction in securities, or the interest, royalties or fee for technical service chargeable to tax under section 115A to 115 BBE. For example, a royalty under section 115A is liable to be paid. The tax liability is taxable. It is taxable at the rate of 10%. If this is the case, whatever the expenditure you incurred for earning this income, if you are a foreign company, it is required to be added back. The income that means the royalty income is required to be reduced while computing your both profit. Got it? Any question? Any query? The remaining portion we will discuss on some other day. The time is not permitting me to complete the entire thing. Any question? Someone is asking that advance tax and TDS paid shall be deducted from the MAT provision tax. Yes, both shall be reduced after finalization of your tax liability. That is your tax liability. How you meet that tax liability? Advance tax and TDS are the mode of payment of your tax liability. Yes, that both of them shall be adjusted. Will advance tax to be calculated as per MAT if MAT is applicable? Absolutely, yes. If MAT is applicable, if you are estimating that in my case MAT is applicable, you are supposed to pay advance tax accordingly. If you fail to pay, interest under section 234B as well as 234C is applicable. Securities premium is reflected as a minus item. We will discuss in next session. If whenever it was be there, we will discuss later on. This is here in reduction item. Here it is. The story of entire securities premium is here. We will discuss in next session. If any interim, whatever name called, whether it is interim dividend, final dividend, proposed dividend, it is required to be added back. Any more question? Do you have any question till now? Hopefully you enjoy the session. Thank you.